because this is the methodology we've been following. So if price creates a new structure, in other words, it's been going like this, right? And now you have, that's the new structure, right? A reversal. And, we could call it a shift or reversal. Reversal, we'll call it. Reversal of price. And the structure now has shifted. Okay. You are now, in a phase where price is reversing. And typically what it does right after it reverses, there's some uncertainty of what's going to happen. So it usually chops. And then it goes into a consolidation phase. And then it could go either way. This is like stuck in the middle where the markets were for a month or so, right? Remember we went through those charts and we were in consolidation, up, down, up, down, up, down. So you're in this consolidation phase and it could go either way. If it breaks one way or it breaks the other way. Now, what we did, if you recall, is we added our narrative to the consolidation phase. What do I mean by that? I mean geopolitical tensions in the Middle East, oil prices rising, dollar rising, right, because of inflation. Yields were rising for fear, potentially fear of recession, probably not going to get a rate cut. Economy weakening, so bondholders are requiring more premium. When they require more premium, yields go up. When yields go up, high dividend stocks suffer. Why would you sit your money in utilities or real estate holdings where you're getting a nice dividend when you get a better dividend and safer investment, not risk on, but a safer investment in the bond market. So, so we had this narrative of oil prices going higher, although that hadn't happened yet. Dollar going higher, Bitcoin had broken down, Nvidia had challenged the highs and had failed. So Nvidia no longer showing strong, Apple breaking down, tech selling off, software industry getting battered, cyber industry battered, chip market getting hurt. Like, okay, we have a narrative now. So while price is consolidating, I'm starting to load up my short portfolio trades because I think it's going to break to the downside because of all of the conditions. And it did. So when it breaks down out of the consolidation, you get the first confirmation. This obviously works in both directions. You get the first confirmation that there's going to be some kind of correction. The first confirmation. So this is when you want to initiate trades. Once you get a confirmation, you initiate short positions. And you don't go out too long, too far, not too far out. But this is when you initiate it until you get the second confirmation. And that's usually a breach, of one of the broad moving averages, like the 100 or 200, broad MAs, or some support level, major support level. And that's when you can lean, what I refer to as lean in. And as the late great Richard Pryor would say, we leaned in like we lean in, and we go further out because now we want time. We don't want to get stuck in the theta burn. We want to put it further out and give the markets a chance to actually roll over. They might go into mini consolidation before, so we don't want to do short-term trades. Now we're going further out because we've got our second confirmation of the correction. And now you are in correction territory. If you bounce and fail, bounce again and fail, and you get a further move to the downside, depending on the percentage, you could be in a bear market. Does everybody understand this role here? So at any point in time, either in the consolidation phase, that we get back above here, if that's the case, right? After, then you renew your move. Remember, price was going like this, right? And we got a shift, consolidated. If it heads back up, we renew the move. We're still in trend. The trend didn't break. We got through consolidation phase, and now we're still, doing, that upward trend. Everybody with me? This makes sense to you guys? But because it broke to the consolidation zone, that was the first confirmation that we needed to start putting on some shorts. When it broke the 200, that's when we leaned in and we went out further. We went further out. And if it continues to fall, you might end up with a bear market. So now let's look at, so what happens now? Well, now we're here. Well, no, sorry. So now we're like here, right? So we did this, we broke this, and then we broke this. Let's just say that's the 200, right? So now what has happened? Well, we got a little piece of news. We have a little bit of a relief. Boom, 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 boom. And now we're back above. Are we back above it yet? I don't think we are. So right now we are here. We're getting a little bounce. You can call it a relief rally, but I don't. It's a bounce. And so now is the time to potentially hedge our shorts, right? You want to put a little something on, but we're going to go short term on it. So we'll look for some things that we could put on right away. If you get back above this, you are basically in a bit of, I wouldn't say a full recovery, but back above there, the correction has been halted. And you are now in a recovery stage, right? Definitely in a recovery mode now that you're back above the 200. And so once that happens, you do want to exit most of your shorts at that point. And then you kind of ride some of your hedges. And if it turns out that you get back above the first confirmation, that's the 200, that's the 50. You get back above here, okay? You are in a recovery rally. And now it's time to switch gears. And now at this point, you can start putting on long trades. And so you are no longer net short. Now you've got long trades on. When you break through here, you're now in a trend. And guess what you do when the market reverses from here? What do you suppose you do now once you're back up in this range and the market does a little pullback? What do you do there? You hedge. Well, yes, you could add. You could do all that depending on where you are here. But you follow the same methodology as when it was to the downside. So yeah, you can. So, when you're doing this and it breaks down, okay, you short, you buy puts, right? If it does this and breaks down, you buy more puts, right? For that. And then when it starts to do this a little bit, you can hedge. But when it does this, you want to get out of your puts. And so now you're going to go long with calls. But when it does this, now you hedge with some puts. Hedge. Add to your calls, like Daughter of the King says. You can add a little bit. And then when you do this, take that out. Now you lean in on your longs. Yeah. So it's the same, strategy for the upside as it is for the downside. Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.